Jake bought a rental property. Marcus bought index funds. Both started with the same £50,000. Both believed they made the smarter move. 20 years later, one of them was exhausted, one of them was shocked, and the final numbers weren't what anyone expected. Because when you count all the money, all the time, and all the stress, everything changes. Meet Jake and Marcus. Same age, same city, same salary, £55,000 a year. Same starting point, £50,000 saved. No inheritance, no lucky break, no secret advantage. Just one decision. Jake uses his £50,000 as a 20% deposit on a £250,000 rental property. Marcus invests the same £50,000 into a low-cost total market index fund. Then he adds £300 every month automatically. That's it. One buys bricks and mortar. The other buys pieces of thousands of companies. And both are convinced they're right. Let's be honest. In the beginning, Jake looks like the genius. He owns a real house. He has tenants paying him rent. He can drive past the property and say, "I own that." That feeling matters. Real estate feels powerful because it's visible. It's tangible. It sounds impressive at dinner parties. When Jake says he bought an investment property, people lean in. When Marcus says he bought index funds, people change the subject. And Jake has one giant advantage: leverage. He used £50,000 to control a £250,000 asset. That means if the property rises 5%, he benefits from growth on the full £250,000, not just his deposit. That's why property can create wealth quickly. And there are tax advantages too. Mortgage interest deductions, depreciation in some countries, expense write-offs. On the surface, Jake looks miles ahead, but that's where everything changes. Marcus has no keys, no tenants, no house, no story, just numbers on a screen. Year 1, maybe his account grows a little. Year 2, maybe a little more. Then it drops, then rises, then drops again. Nothing exciting, no rent check, no physical asset. No one congratulates him for buying an index fund. And this is why so many people quit too early, because boring often looks like losing at first, but boring and powerful are not opposites. Sometimes they're the same thing. Now let's talk about the number everyone loves to brag about: monthly cash flow. Jake's mortgage payment is around £1,330. Rent is £1,800. That looks like £470 profit every month. Easy money, right? Not even close. Because before Jake keeps a penny, there's property tax, insurance, maintenance, repairs, vacancy, legal costs, advertising, cleaning, wear and tear, and eventually, big-ticket disasters: a leaking roof, broken boiler, failed plumbing, new flooring, appliance replacement. One surprise repair can erase months of profit. Then there's the cost nobody puts in spreadsheets: time, late-night phone calls, weekend viewings, chasing contractors, tenant complaints, missed lunches, dealing with emergencies. And the emotional cost? Real. Because passive income often isn't passive at all. It's active income wearing a different outfit. Meanwhile, Marcus is doing something that feels like nothing. He keeps investing. £300 a month. Every month. No drama. No emergencies. No leaks. No texts at 10 p.m. And slowly, something invisible starts happening. Compounding. At first it's unimpressive. Then noticeable. Then ridiculous. Because returns begin earning returns. Then those returns earn returns. And after enough time, growth starts coming faster than contributions. That's when the machine wakes up. This is why many people underestimate investing. The magic happens late, very late, and most people leave before they see it. After 10 years, who's winning? Let's use realistic estimates, not guarantees. Jake, after 10 years, property value may grow to around £335,000 to £350,000. Mortgage balance reduced significantly. Equity roughly £170,000 plus, depending on appreciation. some rental income collected. But years of expenses, repairs, admin, and risk. Marcus after 10 years, £50,000 initial investment, £300 monthly contributions. Portfolio potentially around £165,000 to £180,000 assuming strong long-term market returns. So financially, they're surprisingly close. But lifestyle? Very different. Jake built wealth while managing a small business. Marcus built wealth while living his life. And this is where most people get it wrong. They only compare returns. They ignore the journey. Now fast forward to year 20. This is where the gap or lack of one shocks people. Jake after 20 years. Property worth perhaps £450,000 to £500,000 plus depending on market. Mortgage nearly gone or fully paid. Strong equity position. Years of rent collected. But decades of upkeep, taxes, turnover, stress, and concentration risk. Marcus after 20 years. Portfolio potentially around £420,000 to £460,000 with £300 monthly investing at strong average returns. Very similar ballpark. Let that sink in. One path involved debt, tenants, maintenance, and constant oversight. The other involved automation and patience. And if Marcus had increased his monthly investing by just £200 more, his portfolio could jump to roughly £550,000 to £600,000. That's the hidden superpower of scalable investing. With stocks, increasing contributions is easy. With property, growing often means another deposit, another mortgage, another workload. Now let's be fair. Real estate absolutely can win, sometimes by a lot. Property wins when 1. Strong rent-to-price ratios. If rents are high relative to purchase prices, cash flow improves immediately. 2. You're skilled at operations. Great investors buy well, screen tenants properly, control costs, and run systems. 3. House hacking. Live in one unit, rent the others, reduce your own housing cost. 4. Smart leverage. Borrowing amplifies gains when markets rise. 5. Tax strategy. Certain deductions and exchanges can be powerful. Real estate is not bad. It's just not effortless. Index funds shine in different situations. They win when 1. You're busy. Doctors, nurses, teachers, engineers, parents. People with careers and lives. 2. You value low stress. No tenants. No repairs. No chasing payments. 3. You want liquidity. Need cash? Sell part of your portfolio in seconds. Try selling half a bathroom. 4. You want diversification. Thousands of companies across industries. Not one house in one postcode. 5. You want scalability. More income? Invest more money. No new mortgage required. For many people, the best investment is the one they'll actually stick with. So who won? Wrong question. The real winner is the person whose strategy matches their temperament, skills, and goals. Some people thrive owning property. Others hate dealing with people and love automation. Some can stomach stock market crashes. Others prefer something tangible. The trap is not choosing real estate. The trap is not choosing index funds. The trap is copying someone else's path without understanding the full cost. In money, in time, in stress, in freedom, because wealth is not just what you own. It's how you live while building it. So tell me in the comments, if you had £50,000 today, would you buy a rental property or invest in index funds? And more importantly, why? If you enjoyed this breakdown, subscribe for more honest money content with no hype, no fluff, and no fake gurus. Because the smartest financial decisions usually look boring until they work.